In our fourth quarter commentary, we said that we expected the first half of 2012 to again be a risk-on, risk-off investing environment, but with less volatility than we saw for most of 2011. Volatility was significantly lower in the first quarter, reaching a low not seen since early 2007. First quarter stock market returns were the best in almost 14 years for the Dow Jones Industrial Average and the S&P 500, and the best in over 20 years for the NASDAQ 100. The Dow Jones Industrial Average rose 8.1% during the first quarter, the S&P 500 was up 12%, and the NASDAQ 100 was up 18.7%. In interpreting these returns, several things are noteworthy. While not in the Dow Jones Industrial Average, Apple Computer makes up over 4.5% of the S&P 500 and about 18% of the NASDAQ 100 index. Without Apple, which returned 48% during the first quarter, the returns of these two indices were more modest, but still impressive. Excluding Apple, the S&P 500 returned 9.7% and the NASDAQ 100 returned over 10% for the quarter. When companies announce their revenue and earnings for the quarter, this almost always has an impact on the U.S. stock markets. And although earnings for the fourth quarter of 2011 grew at the slowest rate since the fourth quarter of 2008, earnings growth for the quarter was still attractive. 62% of the companies making up the S&P 500, for example, beat analyst earnings expectations. That quality of earnings is very positive and is one of the reasons U.S. stock markets were propelled up in the first quarter. Domestic stock markets also responded positively to improving U.S. economic news. For instance, February's employment report showed non-farm payrolls increasing by 227,000, which beat economists' expectations. Retail sales, orders for durable goods, basically things that last more than 3 years, and personal consumption were all up. Concerns about the Greek debt crisis whipsawed the markets for much of the first quarter until Greece talked private bondholders into taking a 75% loss on their holdings. After that, market concern over the Eurozone financial crisis eased somewhat. This was not to last long, though, as concerns about a recession in Europe, a weak showing at Spain's Treasury auction, and a slowing Chinese economy have produced negative stock market returns so far in April in spite of good earnings reports. There are, however, some important points to note about the striking rise of the equity markets during the quarter. As you might expect, the U.S. stock markets did not rise in a straight line during the quarter. For example, out of the 62 trading days in the first quarter, the S&P 500 was down 36% of those days, flat 11% of the trading days, and up 53% of the trading days in the first quarter. In addition, 72% of the S&P 500's return for the first quarter occurred on 6 trading days. On average, those 6 trading days were 11 days apart from each other. And finally, average daily trading volume for the broad U.S. stock market reached lows not seen since 2007, indicating a lack of institutional commitment. Treasury bonds, which were the star of 2011, did not fare as well as stocks during the first quarter, ranging from a quarterly return of 0.8% for TIPS, or Treasury inflation-protected securities, to a loss of over 7% for maturities of more than 20 years. As investors increased their appetite for risk, safe havens were not in such big demand. And finally, commodities did pretty well during the quarter. Gold was up 6.7%, Silver was up over 16%, and copper rose over 11%. Crude oil advanced 4.2% during the quarter, while natural gas continued its decline. If you'd like more information about the first quarter or our market and economic outlook for the remainder of 2012, please contact your relationship manager. We look forward to speaking with you, and thank you for being a valued client of LifePlan Financial Group.